All right, we can go ahead and get started. So this week we're going to talk about accounting for income taxes. And as most of you, if you've looked at the chapter for this week in here and in tax, if you have both classes, it's basically the same exact chapter. I did not plan that on purpose, but in income tax this week we're talking about accounting for income taxes, and in this class, same thing. And really, I compared both chapters, and the only significant difference is in income tax, it will reference specific statutes from the code, but that's kind of just in the introductory materials. And then most of the chapter just talks about the concepts behind doing the accounting for, or basically accounting for the differences between what you report on your company financial statements and what the IRS requires. So, if you're in my tax class tonight, I'm not going to make any of you guys come and repeat the same lecture, because I basically give you the same lecture over again. So, you, I guess, kind of double dip today. But basically, when we talk about accounting for income taxes in either class, we're not really talking about doing the income tax, right? At this point, we're just assuming that any calculations for figuring out what your income tax owed is for the year are done. Okay. Now we're at the point where, okay, we figured out, we calculated our income tax owed or whatever for this year or future years, and we figured out what our book should be for financial statement purposes, and there's a difference, and what do we do about that difference? Okay, because in this class, the context being financial statements, what do your financial statements need to reflect to show that you either paid taxes on income that you didn't have to report in your financial statements, or didn't have to pay taxes yet on income that you reported on for financial statement purposes, but you'll later have to pay taxes on in a future year. And you can see how that difference from a financial statement standpoint could be fairly substantial, because if you reported this year a bunch of income on your financial statements, most investors looking at that would assume, hey, he reported the income this year, he probably, in whatever he's reporting for his income tax or her income tax liability for this year, they probably included that because they probably had to pay tax on it. Okay, that would be the assumption most people would have if they saw your financial statements and a certain amount of income. Okay? If you don't say any differently, that's what most investors or outside people would think. So they need to know if you're basically reporting income that's showing up almost like it's tax-free this year, but will have future consequences. Because this year looks real good, but then 3 years down the road, when you have to pay that tax, or next year, whenever it is, based on the differences, then all of a sudden, investors, creditors, etc., might get nervous. Okay, so to alleviate that problem, you're going to include, well, basically what we're talking about today in class. You're going to include journal entries and disclosure notes in your financial statements to let everyone know, hey, we either recognize this income this year for financial purposes but not tax, or vice versa, or even for tax purposes, hey, we did this thing this year that's going to result in a future tax benefit, okay? Because as accountants and doing financial statements, we follow the matching principle. We want to match benefits that we receive with the costs associated with them, okay? So if we're doing something right now that qualifies us for a tax break in the future, that's essentially an asset that we got or are getting because of something we've done or are doing. Okay, So if we've already done this, or we're doing it currently, and we're going to get a benefit because of something we've already done, well, to follow the matching principle, then we really should be showing that on our financial statements right now, because the benefit is essentially earned right now. Okay, so that's kind of what we'll be looking at today. And I covered a lot of the first couple slides just in talking there. Let's see here. Okay, yeah, I didn't talk a lot about this, but why are there differences? We know that there are differences, but why? Well, the government obviously has, or at least that component of the government, the taxing authority, has different objectives than the arm of the government that regulates financial statements, the SEC, at least for major corporations. In doing financial statements, the idea is we want to protect investors and outside users of this information from getting screwed over by these companies, so that there's confidence enough to invest so that our economy thrives. Okay? As a taxing authority, we care about two things: getting money for the operation of the government, and two, the government, basically since the inception of income tax back in the day, has used that as a way to kind of persuade you to do what they want you to do. So you may remember in the recent past a lot of contention throughout the country about gay marriage. Okay? One reason why it was important for a lot of people in these relationships to be legally married, other than whatever that meant to them individually, was that for a long time the government has tried to promote marriage through tax breaks. Okay? The government has deemed marriage a good thing, and so they want to encourage marriage, and so they give these beneficial tax breaks to married people. Well, obviously, if you're a homosexual couple and you see other people who are couples getting these tax breaks, you probably want them too. And that's why that or at least one of the reasons that was a big issue. Obviously, just equal treatment in general, huge issue as well. But you see this in all kinds of things. The government promotes investment by taxing capital investment at a lower rate than your normal tax rates. The government tries to take care of the poor by having these tax credits for lower income people. I mean, there's any number of things. If you look at a lot of the things that are in the tax code, I would say a large percentage of them at least have some policy reason behind them, if not that being the sole purpose of the regulation. So obviously, if you have different goals, and you both are setting up rules, then the rules are going to come out and be different. And that's why we have differences. So obviously, try to get this whole thing up here without going on to the next one. Okay. When you're talking about differences between what you have to report on your taxes and what's on your financial statements, the differences can either be temporary, which means, hey, the tax code says recognized income this year. The financial statement GAAP says, GAAP regulations say recognize it next year. Obviously, if you wait 2 years down the road and compare those two periods of time, they're going to equal out. It's just one will be in 1 year and one will be in the other year. So if eventually both paths come back and converge, and you will balance out as long as you go further enough into the future, and it's just a timing issue, then that's a temporary difference, okay? And temporary differences typically give rise to the need to recognize a deferred tax asset or a deferred tax liability. Okay, and what that basically means is if for financial statement purposes, for instance, you would recognize income this year. Well, if you recognize that same income on your taxes, that would be an additional tax to you, right? So if you don't have to recognize that this year, but you will next year, and on financial statements you did recognize that income this year, well, we want to match the tax liability of the income on our financial statements. We want to match the tax liability in the same period as the income, okay? Because if we don't, we're not following the matching principle. So what we'll do is we will recognize on our income statement as tax expense any taxes associated with the income that we are reporting on our financial statements. That doesn't mean we're paying all those this year. It just means, hey, on our financial statements we recognize this income. That income has attached to it right now, as of today, this tax liability. Some of it we have to pay this year, some of it we'll have to pay in the future. Okay? The amount that we have to pay in the future shows up as part of the journal entry, shows up as a credit to a deferred tax liability. Because that means, hey, we haven't even incurred this tax liability yet. We just know we're going to based on this income in the future. So but for matching purposes, for matching principle purposes, we need to have it show up on our financial statements. Okay? So any amount that of that financial statement income that is reportable on our taxes this year will make us pay tax for that amount this year. So the journal entry will look like this. I think it's one of these next slides here. Hold on. Well, I don't have it in entry form, but this shows what I'm talking about here for deferred tax liability. And then this part is where I'm talking about with the journal entry. And let's see, did I bring a marker? Okay. So you'd have a debit and this is in, if you look at the PDF of the slides for the slideshow, it has more of the illustrations in it. I took those out for the lecture, but it shows a number of these journal entries. But this is what it looks like. Okay, so let's assume this is basically a year's worth of tax that we're recognizing here. So the entire amount of financial statement income that we're showing this year, whatever our tax rate is, or what our effective tax rate, so what we're actually going to have to pay on our taxes, we'll multiply the amount of income that we had times whatever that tax rate is, and that's the amount we'll recognize as a debit to tax expense. Okay? Your book talks about this as a plug, okay? Because what your book wants you to do is to first calculate and start with, well, what do we have to pay in taxes this year? Okay? And whatever we have to pay in taxes this year, we're going to compare that to whatever the total amount is we figure we're going to have to pay based on our tax rate times total financial statement income, which is essentially our total tax liability. And your book goes at it backwards from that, I guess I should say. I think the easier way to do it is look at your financial statement income, multiply that times your effective tax rate. That gives you your tax expense. The amount you pay this year will show up in either taxes payable, that's likely, or if you're immediately paying it right then, it would just be a credit to cash. Okay? But what's likely is it will show up in taxes payable, and then whenever that business cuts checks to employees or whatever, it will cut a check or a wire transfer to the government for whatever these taxes payable are. And then the difference between those two is your deferred tax liability that you're carrying forward into the future. Okay. Get all this up here. Don't worry too much about book versus tax basis. I'll talk about that and add a note to that for tax class, but actually I probably would have taken this slide out if I had looked at it more carefully. Let's talk about deferred tax assets. Okay, so obviously the difference between an asset and a liability is an asset provides future value to you, a liability takes value away from you and requires you to pay it in the future. So anything from a tax standpoint that is going to provide a tax benefit to you in the future will be reported as a deferred tax asset. Okay? And what that ends up being is typically you'll do something or qualify for some type of future tax deduction. Okay? And if you think about what a tax deduction means, typically what that means is whatever deduction amount that you're allowed is an amount you can pull your income level down by. So that doesn't mean you're reducing your taxes by that amount, okay? It means you'll be able to reduce your income by that amount. So the amount that you're actually saving or the actual benefit to you would be whatever that income is that you're reducing times your tax rate, okay? So if you multiply the income that you're reducing times the tax rate, that tells you what your deferred tax asset would be. All right, let's take a look at this example for valuation allowance. Okay, so this is when we talk about an asset, and this can be true for a liability as well. But basically, what we're doing here when we talk about deferred anything is we're kind of predicting into the future. And that prediction may be a great prediction based on all the information that we have right now. The problem is, especially when we talk about taxes, is the tax code changes basically yearly, almost continuously. Okay? So if we're projecting out 5 years into the future that, hey, something we did today will give us a deduction 5 years from now, that's good, and that's what we should do because it's the best that we have available to us based on current knowledge. Well, if 2 years from now, or in our case now 4 years from now, let's say a new administration comes into office in the U.S. presidency, and then Congress, the total demographics in Congress and the control is completely changed, and there's a huge tax overhaul between when we put this on our books and when it was actually supposed to happen, so that it disappears or it, worse, maybe goes from being a tax asset to an actual liability. Now, I can't think of any concrete examples of that having happened so drastically, but for instance, with this administration coming in, one of the ideas was repeal Obamacare. Well, there were tax penalties and benefits associated with some components of Obamacare for businesses, and so some businesses may have had on their books deferred tax assets or liabilities associated with Obamacare that if anything had or does in the future go through that repeals that could totally change. And it's not huge with respect to Obamacare, but these could be big numbers depending on what the change is in the future, if it's something that's more germane to business. And obviously, I guess I should say, if you're in the healthcare industry, repealing Obamacare could have huge impact, okay, as far as, not just in general, but as far as these deferred assets and liabilities. Okay. So in this case, we had Tomorrow Publications reported pre-tax accounting income 2016, 2017, 2018 of 80 million, 115 and 105 million respectively. 2016 income statement does not include 20 million of magazine subscriptions received that year for 1 and 2 year subscriptions. The subscription revenue is reported for tax purposes in 2016. Revenue will be recognized in 2017 and 2018. Income tax rate is 40% each year. Management determines that it's more likely than not that 3 million of the deferred tax asset ultimately will not be realized at the end of 2016. So this is basically just like any other assets you might have. Once you have information that suggests that what you have on your books is incorrect, then you would go in and change that. Okay, so this would just essentially be a credit to valuation allowance, and then here just labeled deferred tax, but that wouldn't necessarily be there. And then you would show an additional $3 million in income tax expense. Okay. Just continuing on with that. Let's talk a little bit about permanent differences. Okay. Permanent differences, just like the name implies, means, okay, we're different today, and instead of coming back together and being the same, if you look at it from a 5-year period or a 10-year period or however long, we're going to stay different incomes basically forever, okay? At least if you include this particular year or whenever these permanent differences occur. So what this means is, instead of having a timing difference in recognition, we're talking about things that are essentially, what we're talking about are items that for whatever reason are tax-free income. Is usually where this occurs. So for instance, if you're as for whatever reason investing heavily in municipal bonds or state bonds, okay, these are local bonds, are income tax-free to the holder. So the interest that you earn on these bonds is completely tax-free. Okay? So for income tax purposes, this is not income. But obviously on your books, it's money coming in, so it's income. Okay? So this will lead to a permanent difference, unless, of course, something happens that retroactively changes the tax code and makes these things non-tax exempt. But that basically has never happened and probably never would. Okay, so for permanent tax and book differences, basically you have to have disclosure showing that these things are out there, and essentially on your financial statements you'll have, as a component of that, a reconciliation that says this was our book income for the year, this was our tax income for the year, this is why they're different, and shows the components of that. So obviously, in this case, municipal bond interest would be one of those components. Okay? But for the purposes of what we're talking about with deferred tax assets and liabilities, we never even have to touch these things, because effectively what happens is they just don't exist for tax purposes. So obviously you're not going to put them down under taxes payable or deferred tax anything, because they're just unaffected by tax. Yeah, like I just said, no deferred or any, basically, you'll have no accounts associated with tax or with the word tax in them associated with these permanent differences. Effective tax rate, if you remember, is basically taking all of your income and all of the taxes you paid and finding out what percentage your taxes are at relative to your income. Okay, so basically means ignore all deductions and any write-offs and anything like that that you had. Put all that stuff back on the table and compare that to the amount of tax you paid and see what the percentage difference is, or the relative percentage of those are. Okay, so obviously if you're doing that, then any permanent differences will obviously affect your effective tax rate, because what effective tax rate does is it captures all of the items, even the items that are not recognized for tax purposes typically. So this rate is what got, going back to the political examples, this rate is what got Mitt Romney in a lot of trouble back in the previous election, or maybe it was the first time he ran. But anyway, when they looked at his overall wealth and compared it to the actual amount of taxes he paid, it ended up being some ridiculous number like 8% was his tax rate on like $450 million of income. So obviously that pissed a lot of hardworking Americans off, where, you know, like a middle class family may be paying an effective tax rate of like 15%, and this ultra wealthy guy who's now telling us he's going to represent our interests is paying 6 or 8% or whatever it is. Okay. So if you remember, basically effective tax rate obviously will include this because it captures everything that affects income. Let's see. This slide is basically just saying, even if you have tax proposals on the table that could or seem likely to you, or the writing's on the wall that they're going to pass, and they're going to change all of this stuff, and it's going to make it so you don't have to report this deferred tax liability because it's going to give you this great tax break or whatever it is. Until these are actually signed off or signed into law, you can't base any of these calculations on anticipated rates. And obviously, especially in the tax world, the reason why is because many things happen between these would-be deadlocks to pass and them actually going through. And if you think back, I don't know how many of you actually care about politics, but if you think back to the beginning of this election cycle, very few people actually thought Donald Trump was going to win the election. So you can't really, even if every news source and every source of information you have tells you this is going to pass, all of these senators and all of these people on the House have already committed to signing it. It's basically signed into law already. If that is what the news you're getting on December, well, basically on January 15th when you're doing your books for the previous year, doesn't work like that. You have to wait until it's actually enacted. Yeah, so again, anytime you basically have on your books some deferred asset or liability that's based on good information at the time, but then ends up coming out differently or changing, or something happened to where it didn't work out the way you thought it was, those results are captured in operating income in the year the change is enacted. So basically, as soon as we get the information, that's when we're going to push it through onto the income statement, because obviously operating income is our revenue minus expenses. So that is essentially what we're capturing in our income statement. Let's see here. Okay, net operating losses. So the big thing to remember, obviously, if you have a net operating loss this year, what does that mean? It means you compare your revenue this year to your expenses this year, and your expenses were more than your revenue. So if your expenses are more than your revenue, you're obviously not paying tax this year, okay? At least income tax, because you have no income. You lost money. So the important concept with respect to net operating losses is not what you're doing with it this year, but what you're able to do with it, carrying it backwards and carrying it forwards. So you can carry it backwards 2 years, and you can carry it forwards up to 20 years. Okay? Why is that important, or how is that beneficial? Well, obviously, depending on what age or what period you are in the growth of a company, if you're right at the outset, generally you're losing money. If you look at even some big examples lately, like Facebook, for instance. Facebook, for the longest time, had no income. Okay? Even when they went public, they had no income. So that means any financial statements they had, they were all net operating losses. Okay? And that is super, super, super common in the tech industry. Okay? Because you have to basically build these things all up, and they have to become ultra popular before the monetization starts, or that kills off the popularity. So anyway, for a company like that, if you did not have this option, then you have years of losses that did nothing but hurt you. Okay? So basically, this policy of allowing you to carry it forward and even backwards encourages the forward portion, encourages companies or encourages people to start companies, because they know that, yes, it's risky in the first few years, but you're able to, if you're able to weather the storm during the first few years when you're not making any money, you're then able to use that as a tax benefit in future years to catapult and kind of exponentialize your growth. Okay? Similarly, if you're already established as a company and you decide, hey, now's a good time to invest more in my company and grow, that may cause an already established company to lose money for a couple of years. Well, now, not only can you carry it forward, and maybe because of your growth, even the first couple of years, you're not going to make a lot of money, and so you're not going to get charged a lot of taxes. But maybe in these 2 years, you had made a ton of money, and that's what facilitated this growth. And so it's more beneficial for you to carry it back a couple years, get it to count towards the higher tax rate that you had in those years. So again, like I said, a lot of these policies, or I should say statutes in the tax code, are related to encouraging, especially business, to thrive and to grow. What that means is, from discussion of what we talked about today with deferred tax assets and liabilities, is that if you're carrying something forward, that creates, in the future, a tax benefit for you, an asset. Okay? So any amount of loss that you're able to carry forward, you're going to, in whatever years you use it in, going to be able to lower your income by that amount. So it creates this tax asset. Okay. If you carry it back, then basically this provides an immediate tax refund, because what happens when you basically file a form to correct previous tax returns is you say, hey, I paid too much these years, cut me a check for the difference. And so the government sends you your money back. So that, again, would create some current income. Okay. Now, obviously, where it goes on the balance sheet, again, it's brought up repeatedly throughout the book. But if you just remember, current assets are anything typically within the year that are going to turn into cash or a cash benefit. So if within the next calendar year you're going to be able to use this tax asset, it would be current. Or if you're going to have to pay this tax liability, it's going to be a current liability. If it carries on beyond that, then it will be a long-term or non-current asset or liability. Sorry, I'm just trying to see how much I want to spend on this one. Whoops, sorry. Okay. Anytime you see your book talk about disclosure notes, again, this is going to be the first page after the main financial statements that you see in your annual report if you're a Fortune 500 level company. You're going to see the notes to the financial statements. So if you look at a company's annual 10K, which has their annual report in it, for a big company, these may be 150 pages long. Okay, so the financial statements and the portion of it that is financial statements and maybe descriptions of the charts or whatever associated with the financial statements, that probably covers the first 25 to 30 pages. Okay, and then the last 125 pages are notes to the financial statements. So there's a lot in there. Okay, a lot of it is essentially meaningless to whoever's looking at it, investors or whatever. But a lot of it has useful information in it as well. So this is where, if you're carrying these forward into the future, this is where you're telling your investors exactly how far into the future these are being carried. And why that? I mean, again, with the notes to the financial statements, pretty much anything in there could be viewed as useless or of great value. It just depends on what you're trying to determine. So the information about net operating loss carry forwards and the timing on them, when you expect to get them, etc. If your only concern is profitability next year, or likelihood of getting dividends back next year, or something like that, then the timing on a non-current anything is probably meaningless to you. Okay, so it's hard to say. I mean, it's all going to be very subjective as far as what is of value and what's not. But just know that any sophisticated user of financial statements will at least know if they want to find this information where they can find it. Yeah, I meant to delete this slide, I'm sorry, but this slide is very confusing to me. So don't pay any attention to this slide. For some people it has a benefit when you look at it. for the purposes, if you're very comfortable with key charts and that's how you figure everything out, then this slide is somewhat beneficial because it shows you the balances in the T charts and for these various accounts and where they would show up based on those balances in this journal entry down here. Obviously, assuming you had any of these categories. Okay. The ones, I don't even think there's any questions on these bottom two categories that are in the quiz at least. But the ones that I want you to focus on most for the purposes of this class and for the CPA in general is just knowing that the function of that basic journal entry, the fact that tax expense for this current year includes both taxes payable based on income you had to report in your income taxes this year, and any portion of income that was not reported on your taxes this year, was on your financial statements, but will have to be reported in the future on your taxes. If you know that much and can, if you know that much, basically you are at least good down to here. And D and F, I'm trying to think. I don't even remember ever seeing anything about valuation allowances or uncertain tax positions on the CPA exam. Pretty sure everything I've seen in CPA prep and on the exam itself just covers that tax liability or deferred tax liability. Also deferred tax asset being on the other side and tax expense. Okay. That might be the end of the slideshow. Yeah. Okay. Anybody have any questions on that? But like I said, for the tax portion, for those of you in my tax class, the main difference is that you would cover all this information, but basically the citations to the code sections are included. So everything else pretty much identical. So if you guys have any questions, let me know. We're coming towards the end of the semester, so I think we have, after this week, I think we have 2 full weeks of class, and then the week after that is when you guys will have your final, okay? And that's the week before your actual finals week. Anybody have any questions on timing or anything? All right, I'll see you next time.